Trading iron condor options. An iron condor consists of 4 different options contracts, 2 calls and 2 puts. The trader sells one out of the money call and buys another call with a higher strike price, while also selling one out of the money put and buying another put with a lower strike price. This creates a profit zone where the underlying asset's price remains between the 2 strike prices of the options sold. The goal of an iron condor is to generate income from the premiums received from selling the options contracts while limiting potential losses through the purchase of options at wider strike prices. As long as the underlying asset remains within the range defined by the strike prices, the trader can profit from time decay and decreasing volatility. Iron condor options are particularly well suited for sideways or range-bound markets where the underlying asset's price remains relatively stable. In these conditions, the strategy can capitalize on time decay and generate consistent profits. Since iron condors profit from a decrease in implied volatility, they are most effective in low volatility environments. During periods of low volatility, options premiums tend to be cheaper, making it more cost-effective to establish iron condor positions. Just a quick reminder to please hit the like button and subscribe to the channel. Also, visit us on the web at www.investmentees.com and use code BLOG to receive 25% on your next purchase. The components of an iron condor consist of having both a short and call spread. A short call spread involves selling a call option with a higher strike price and simultaneously buying a call option with an even higher strike price. This establishes a ceiling for potential losses. Short put spreads entails selling a put option with a lower strike price and buying a put option with an even lower strike price. This establishes a floor for potential losses. There are several benefits of trading iron condor options such as income generation. Iron condors can generate consistent income through the premiums collected from selling options. Limited risk. The risk is limited to the difference between the strike prices of the options bought and sold. Versatility. This strategy can be used in various market conditions, including sideways and slightly bullish or bearish markets. Risks associated with iron condor options. Limited profit potential. The maximum profit is capped at the net premium received, regardless of how much the underlying asset moves. If the price of the underlying asset moves outside the range defined by the strike prices, losses can occur. Assignment risk. There's a possibility of being assigned on the short options, which can result in unwanted positions. When trading iron condors, it's essential to choose an underlying asset with relatively low volatility and a history of trading within a defined range. The strike prices of the options should be selected based on the trader's outlook for the underlying asset and the desired risk-reward profile. The expiration date of the options should be carefully considered, taking into account factors such as upcoming events or earnings announcements that could impact the price of the underlying asset. Managing iron condor trades. Setting stop-loss levels. To mitigate losses, traders can set stop-loss levels to exit the trade if the price of the underlying asset moves outside the expected range. Rolling the position. If the price of the underlying asset approaches one of the strike prices, traders can roll the position by closing out the existing options contracts and opening new ones with different strike prices and expiration dates. Common mistakes to avoid. Neglecting risk management. Failing to set stop-loss levels or adjust positions can result in significant losses. Overleveraging. Using too much leverage can amplify losses if the trade moves against you. Ignoring market conditions. It's essential to consider current market conditions and volatility levels when trading iron condors. Iron condor trading tips. Start small. Begin with a small position size until you become comfortable with the strategy. Be patient. Iron condors require time to play out, so avoid the temptation to close out the trade prematurely. Monitor positions. Stay vigilant and monitor your positions regularly, adjusting as needed to manage risk and maximize profits. When adjusting an iron condor trade, traders should consider factors such as changes in market conditions, price movement of the underlying asset, and the impact on overall risk-reward profile. Adjustments may include rolling the options, adding or removing contracts, or hedging the position with other options strategies. Conclusion. Trading iron condor options can be an effective strategy for generating income while limiting risk, especially in sideways or range-bound markets. By understanding the intricacies of this strategy and implementing proper risk management techniques, traders can enhance their overall portfolio performance. Thanks for watching.